Hello and welcome to this special edition of Market Masters. Global financial markets are sitting on the edge, as it were, with respect to the two largest economies of the world. In the US, there is renewed hope for a year-end rally on expectations that both inflation and the pace of Fed rate hikes may have peaked. On China, there are only worrisome questions on the country's real estate space, its zero-COVID policy, and the implications of Xi Jinping's third term. Today, we have with us a veteran to parse these global cues with us and tell us what this holds for Indian equities. Christopher Wood, Global Head of Equity Strategies, Jefferies, and author of the legendary weekly report, Greed and Fear. Chris, thank you very much for sparing time for us. And let me start with the question that's on everyone's mind. Are we in for a Santa Claus rally, a year-end rally in the United States?
Yeah, I think there is a possibility of a rally into year-end, partly because the next CPI data point, which should come out just after the midterm elections, has a better base effect. First point. Second point, if the midterm congressional elections go in a way which the market perceives to be positive, I think both those events can trigger a bit of a rally into year-end, most particularly as we're down heavily year-to-date. Okay. However, having said that, looking into 2023, the fact is the odds favor a US recession. That is Jeffries' formal call, and I concur with that. And probably the best lead indicator of the recession risk in the US next year is the collapse in broad money supply growth. In the last 6 months, M2 has not grown at all in America. Yes, I think there is a chance for a rally if that CPI data point comes out lower.
So your theory would be that it is a year-end rally, but it is a tactical short-term trader rally, and we could be in for some losses in 23.
Yeah, because what was interesting last week is we finally got capitulation on some major US tech stocks. Clearly, Facebook, or what's now called Meta, is the best example of that. But the S&P basically held up. So that shows you the market's quite resilient. And one thing we need to remember about the higher inflation, while it leads to higher interest rates, it also leads to higher nominal GDP growth, and earnings are in nominal terms. But fundamentally, if rates are going up and the Fed balance sheet's contracting and money supply growth has gone to zero, that is negative for asset prices. And in my view, before this correction is over in the US, we need to see major capitulation on all the FANG stocks. So I've got a chart in my presentations last 2 years showing FANGs as a percentage of the S&P 500, and they peaked back in 2020, but that line's going to go a lot lower. And fundamentally, the best sector to have owned last year and this year in America is energy, which remains my favorite sector to own stock-wise.
Hi, Chris.
US. Hello. Yep.
All right. Hi, Chris. Good to speak to you. You know, if NASDAQ is going to go much lower from here, are there any targeted levels that you're looking at? And also, if the midterm elections, they play out according to plan, inflation is well behaved, as is perceived, at least as of now, in the coming couple of months. How much higher could we go with regard to the Santa Claus rally that you're talking about?
No, I'm not. I'm not looking to trade this rally. I just want to own energy stocks. What I'm saying is, though, that you can get a bit of a bounce, but we need to keep a perspective of inflation. Inflation's way above the Fed's target, both core and headline. I'm just saying it could come in lower at the next reporting date, and markets like to celebrate the second derivative, but fundamentally, the inflation remains way higher than the Fed's target. So the key issue for the first quarter of 2023 is, will the Fed stick religiously to this 2% target, or will the Fed, when it sees growing evidence of a weakening labor market and a weaker US economy, in due course fudge that 2% target? In my view, they will fudge that 2% target, and that will be the real signal to buy equities. But if they continue to tighten, that is bearish.
That's the point, Chris. We already have Nick Timiros writing in the Wall Street Journal that several Fed governors are beginning to get worried about the pace of rate hikes. And that was actually confirmed by some of the Fed governors like Daly speaking out that they are worried about the pace of rate hikes. So would you weigh the chances as high that the Fed may chicken out and not go in for contraction?
I know my base case is the Fed will fudge it, absolutely. But if you're long the minor, the key question is the timing. And the problem for the Fed is that the Fed has lost credibility in the last 18 months for the obvious reason that it totally failed to predict the surge in inflation. And the reason it failed to predict the surge in inflation is the Fed doesn't pay any attention to money supply growth. And if you look at a chart of broad money supply growth back in 2020, it was pretty obvious that inflation was going to come back. So the Fed was flying blind. Unfortunately, the Fed is still flying blind because the Fed still doesn't pay any attention to broad money supply growth, and broad money supply growth has now collapsed. So the Fed is partly in a political mission to restore its credibility, and the Fed has an employment mandate, and the employment market remains today relatively strong. So, but obviously the labor market's a lagging indicator. But my guess is in the first 3 months of next year, the evidence of a weakening economy will see more Fed governors talking in the way that Wall Street Journal article reported. And by the way, that journal article was very influential because it triggered the commencement of this rally we're seeing in the recent days. But I think the key Fed governor for investors to watch out for in terms of delivering the message, at least the one I'm going to be watching out for, is Fed Vice Chair Mrs. Brainard, who would have been the Fed chairman, but that she wasn't going to get the Republican votes to confirm her. She's politically connected. She's a Democrat, and she's a labor market specialist. So I think she will be the one to deliver the signal. But I just don't think to me, that article was a little bit premature, the one that happened a week ago.
Fair point. Okay, actually, yeah, the Fed balance sheet has shrunk by about $250 billion, I would think, because of the, Treasury runoff. I'm trying to keep Nigel from getting into India immediately. That's the question he wants to fire at you. But I want first your views on China. We have the property market problems, the zero COVID. What is your sense? Is China going to continue with the zero COVID? Do you see any relief at all for China investors?
Well, I have to say the base case was that President Xi would not formally basically move away from what I prefer to call it COVID suppression, because the Chinese aren't claiming to have zero COVID. The whole policy is about suppressing outbreaks where they occur. So the base case, yes, is that China maintains this policy, as was articulated in that Communist Party meeting last week. But the base case is also, I believe, at least my base case, is very gradual relaxation, though that's not formally admitted in Beijing. The best signal that we're going to have gradual relaxation is that President Xi has stopped wearing masks all the time in meetings. That's probably the most significant signal. I believe they're going to have a marathon in Beijing in the near term. They've stopped quarantine in people going into Hong Kong. There's talk they're going to relax quarantine measures for people entering China because foreign businessmen need to go into China. So I do believe that it's very gradual relaxation. But the problem China's got, and it is a real public health problem, is that they haven't vaccinated all the elderly people. They didn't prioritize the elderly when they started vaccination. And Hong Kong is unfortunately the precedent for China, because Hong Kong also failed to prioritize vaccinating elderly people. And this has become a real issue with Omicron because it's so much more infectious. Hong Kong had the highest death rate in Omicron globally because the population had no immunities because of the extreme lockdown prior to that. We worked out the other day that if you adjust Hong Kong's Omicron death rate for China's population, and China lost control of Omicron like Hong Kong did, then you would have 1.9 million Chinese. So that's the key reason why they're not relaxing as much as many people would think. But clearly, the failure to relax COVID suppression policy is inflicting major collateral damage on the Chinese economy, and most particularly the property market.
But Chris, let's get to the point then with regard to emerging markets. The Chinese market has, hadn't had a good run. Some believe that maybe it had become uninvestable. If they are bottoming out and things are going to reopen out there, valuation-wise, they have that comfort. Between both the two markets, that's India's offering, earnings growth, that market's offering valuation comfort. How would you approach both of them?
Well, yeah, but China's been offering valuation comfort relative to India all calendar year.
Yeah.
So if the Chinese announced today a total opening of end of this COVID suppression policy, I would say the market will be up 25% in 2 weeks.
Oh.
But the base case is that they're not going to do that, and the reality is that most global investors have already deemed China uninvestable. But that's global investors who do not have to invest in emerging markets. Global emerging market investors have to invest in China because it's a major part of the benchmark. But what you will increasingly see, and this process has already begun, you will increasingly see growing interest in global emerging market mandates excluding China.
Okay. That's a big one that you're giving us, Chris. We want to hear more about this and about the relative comfort in investing in India. Have to take a mandatory break. We are back in just 10 seconds.